Welcome to The Explainer. Today we're going to tackle a tool that's, well, it's pretty controversial. Some traders absolutely swear by it, while others just write it off as some kind of voodoo science. We're talking about Fibonacci analysis. So let's just dive right in, shall we? All right, let's start with a really big question here. What if the same math that you see in nature, the patterns in seashells, flowers, even the proportions of a human face, what if that same math also shapes how financial markets move? It's a pretty wild thought, right? That the chaos of market psychology might actually follow some kind of natural, predictable rhythm. And that idea, well, it brings us straight to something called the golden ratio. Now, this isn't just a concept for artists or biologists. Nope. The idea here is that it stretches from the natural world right into the thick of Wall Street. It's all about trying to measure those waves of buying and selling, the collective greed and fear that really drives the market. It's like trying to measure the very pulse of the crowd. Okay, so if there's this hidden code out there, how do we actually find it on a chart? What are the specific numbers we should be looking for? Let's break down the key ratios you need to know. So here they are, these 5 percentages. They're the absolute key levels traders keep their eyes on. I want you to think of them like invisible tripwires on a chart, potential floors or ceilings where a price move might just stop, take a breath, or even turn around completely. And the funny thing is, it almost doesn't matter why they work. Is it some secret law of the universe, or is it just that a ton of traders are all looking at the exact same lines? Either way, the effect can be very, very real. All right, so we've got the numbers. Now what? How do we actually put them to work? Let's get practical and look at the first major tool. This one helps us answer a question every trader asks. When a stock is pulling back, how in the world do you know where it might finally stop and turn around? It's actually a pretty simple 3-step process to draw what's called a retracement grid. First thing you do? Zoom out. You've got to see the bigger picture, the main trend. Then you find your 2 key points, the swing low and the swing high. All that means is finding the absolute low and the absolute top of a big price move. And finally, you just connect the dots. If the trend is up, you draw from that low point to the high point. If the trend is down, you do the exact opposite. And boom, just like that. You've mapped out those potential reversal zones right there on your chart. Now, listen up, because this next part is absolutely critical. Precision is everything. The source material really hammers this point home. If you pick the wrong starting and ending points for your grid, well, you might as well be using a broken compass. You're going to get a faulty map, and that can lead to making some really bad decisions. Buying too early, selling too late, you get the idea. It can be a very, very expensive mistake. Okay, so that's retracements. Let's build on that. The next tool in the box helps us answer a different but just as important question. Let's say a stock finally breaks out past a tough ceiling of resistance. Great, but now what? How high could it go? How do you set a realistic price target? This is where extension grids come in. The process is pretty similar, but the goal is totally different. Instead of looking for a pullback to stop, these are designed to project how far a trend might run after it breaks out. Basically, you're taking the size of the old trading range, that box the price was stuck in, and you're using it to forecast potential targets way up ahead. It's like measuring a springboard to see how high you might fly. So, let's just boil this down because it's a really important distinction. Here's the easiest way to think about it. Retracements, they're for when the market is taking a breather, pulling back inside a trend that's already happening. Extensions, that's for when the market's done resting and is now sprinting forward, breaking new ground. One's for a pause, the other's for a push. But look, just knowing how to click and drag a line on a chart, that's not enough, not even close. The real secret sauce, the thing that gives you a genuine edge, is learning how to fine-tune your approach. That's how you get better, more reliable signals. So here are a few pro tips. First, you want to look for alignment, or what some traders call harmonic levels. This is huge. It's when your Fibonacci level lines up perfectly with another indicator, like a moving average or a previous high. When signals pile up like that, they become much more powerful. Also, know your time frame. If you're a day trader, you really don't need to be worrying about yearly levels, right? And finally, don't be afraid to form fit it a little. If you can slightly adjust your start or end point to line up better with a key chart feature, like a double bottom, go for it. It can make a big difference. Okay, this brings us to the elephant in the room, the million-dollar question, really. After all this, does it actually work, like consistently? Well, let's be honest. According to some studies from the source material, the success rate can be, well, pretty low as 37%. So let's be crystal clear about this. This is not some perfect, foolproof system, not by a long shot. In fact, if you just use it all by itself, it's expected to fail more often than it succeeds. That means you have to use it with a big dose of caution and always look for other signs to confirm what it's telling you. So we've gone through the theory, we've gone through the practice. What's the bottom line here? What's the one thing you should really take away from all this? Okay, let's sum it all up. First off, Fibonacci is not a magic bullet. It's a tool, that's it. A tool to help you spot potential support and resistance levels that you might otherwise miss completely. Second, remember the difference. Retracement grids are for pullbacks, extension grids are for price targets. Got it? Third, precision is key. Where you place that grid makes all the difference. And maybe most importantly, never use it in a vacuum. Always combine it with other technical indicators to confirm your signals. And that leaves us with one final big question to chew on. Is Fibonacci analysis really tapping into some hidden mathematical code of the universe, some secret key that governs the markets? Or is it just a giant self-fulfilling prophecy? Does it only work because millions and millions of traders believe it works and are all watching and reacting to the exact same lines on a chart? Something to think about.